Hey everybody, Mike DeSepoli. Welcome to the Heritage Market Update for Thursday, September 29th, 2022. Hope you're all having a great week. This really feels like one of those weeks where years have elapsed. We have a lot to cover, a lot of news around the international financial markets, what the ramifications will be for us here in the US, and how this is going to all impact the ultimate destination for the stock market. So let's get right into it. Let's start with a surprise move by the United Kingdom, by the British Central Bank, stepping in to intervene in a major currency crisis that started to occur in the British pound. Without getting too deep into the weeds of what was happening, basically, Britain was looking at their own Lehman Brothers type moment, right? If you think back to 2008 and the failure of Lehman Brothers, the British pension funds were under extreme stress due to the collapse of the British pound. Now, why did the British pound collapse? Well, that is because you have global central banks in unison embarking and continuing to push through the fastest interest rate hiking cycle that we've ever seen. And I'm going to get to some data on that in a moment to just show you just exactly the magnitude of how swift these central banks have acted. But again, folks, you cannot make those types of moves with monetary policy without there being some unintended consequences. So we come to find out many of the British pension funds are invested in long duration government bonds, if you will, and the swift movement in their currency was putting tremendous pressure on those long bonds, forcing Britain to pivot, right? The old pivot that we've been talking about, policy pivot, basically shifting course, 180-degree turn from hiking rates and continuing to tighten to now going back to quantitative easing and to stimulate their bond market to suppress long-term yields. So essentially, what that means to us is that the pivot in other global central banks is not far behind. Because if you study monetary policy, you will see that central banks of the world tend to not diverge from one another, meaning you're not going to have many central banks hiking rates while others are dropping rates. So at some point, we will see that alignment. It looks like Britain may be the first shoe to drop. Now, when we talk about the magnitude of what these global central banks are doing, we want to give you a visual representation of what that looks like. So what you're looking at here is the fact that the Fed is hiking further and faster than any time in modern history. And we have some of the previous rate hiking cycles showing the number of months that have elapsed during that rate hiking cycle and just how high the Fed went. Now, the most recent hiking cycle that we went through that essentially caused some pain in the stock market, and the Fed ultimately pivoted, right? Which they've pivoted after every one of these rate hiking cycles. This time will be no different. But the most recent time was the 2015 through 2018 hiking cycle, which really ran about over 3+ years. And at that point, the Fed funds rate hit a level of about 3%. It was too tight for the economy. The economy started to weaken, and the Fed pivoted and started to cut rates. And then we came into the current iteration of monetary policy. So now, when you look at 2022, they have gone just absolutely parabolic with interest rates, right? They have waited too long to start raising them, and now they are trying to make up for lost time, and they have gone just crazy in terms of the pace that they have gone at. Now, again, unintended consequences, right? We want to fight inflation, but what the U.S. does with monetary policy affects everyone the world over. Like they say, when the U.S. sneezes, the world catches a cold, and we are starting to see some of those knock-on effects in other foreign currencies. So it is my assessment, is our assessment, that the pivot here in the U.S. is not that far away. They'll probably get one or two interest rate hikes off, more. And at that point, the deterioration of the economy will be so clear-cut that the Fed will have no choice but to pivot. Now, the stock market will sniff this out ahead of time. So we don't have to wait until the Fed actually makes that policy mistake for the market to come to the realization that a pivot is coming. But this is what this rate hiking cycle looks like in visual form. Unprecedented, never before seen. Let's take a look at a couple other indicators relative to this rate hiking cycle. So we've touched on this before. Let me just zoom it in a little bit. Obviously, the Fed tightening cycle has put immense momentum and pressure behind mortgage rates. And we went from basically a low of 2.65% on a 30-year mortgage a little more than a year ago to rates now that even with the updates this week, we're above 7, right? 7.5%. This is an extraordinary tightening in monetary policy. So when you hear the Federal Reserve talking about the need to tighten financial conditions, this is one of our base case arguments that not only have they done so, they have gone too far. They have gone too far. We are now at a higher mortgage rate than we have seen at any point going back 15 plus years. And again, this will not be without unintended consequences. You already see the housing market slowing. If the Fed wants a recession, they're certainly going to get what they wish for. Let's continue on. Let me just zoom this back out. Now, when we look at liquidity in markets, right, because markets are driven by liquidity. How much money is available in the money supply, and is that money supply being expanded or restricted? So we look at the Bloomberg U.S. Government Liquidity Index, and folks, we are at crisis levels of illiquidity in financial markets right now. Crisis levels. Here's March of 2020, here's December of 2015, and here is where we came down from the crash of 2008. So the Fed is as tight as they could possibly be. It's as tight as they have been for nearly 2 decades. And yet they think they're just going to continue along on this path unchecked without any hiccups along the way. And we got news for them. That is certainly not going to be the case. So what this would suggest is financial conditions are extraordinarily tight. They're tighter than they were during the pandemic lows of 2020. And anytime we've gotten up near the upper band in this chart, the Fed has acknowledged that policy initiatives and policy plans need to be changed. So this Fed's trying to be a little stubborn because they destroyed their credibility last year by telling all of us inflation was transitory, and now they're running through the credit, bond, and stock markets like a bull in a china shop, wrecking everything in their path. This won't last forever, folks, but this is what the Fed is. This is what the Fed does. Everything they do is in excess. The pendulum swings both ways. The pendulum swung to low rates for too long, and now the pendulum has swung to higher rates far too fast for the economy, the global economy, to stomach. Now let's continue on. Now, if you're looking at the market this year and saying to yourself, this feels like the worst market I've ever been through in my life, you are not entirely wrong. Now, total return basis, markets were way worse in 07 and 08, but when we look at the blend of stocks and bonds, right, the diversification, you do everything right, you diversify your money, and this year it has simply not worked. What you're looking at here is year-to-date total returns for the Bloomberg Global Aggregate Index. Folks, this is a measure of the broadest bond market index in the world. We're looking at history going back to 1990, so 32 years of bond market returns, and here's the blue line, bond performance this year. So this is beyond an anomaly at this point, and we are seeing that the investors with a 60-40 portfolio are seeing S&P 500 like returns. That really never happens. Now, as far as market trends go, things tend to revert to the median. So we are currently in probably the lowest percentile of performance the bond market has ever seen, but it's not going to stay this way forever. This is entirely Fed-induced pain in this market. And I'm not saying that as an excuse. I'm saying that as a rationale for why the market is doing this. Because when we look through corporate America, okay, little known fact, the market, the country is in the midst of the 9th most profitable quarter in corporate American history, yet the market is acting like every company is going out of business. This has nothing to do with corporate profits. This has everything to do with Fed monetary policy and the fact that everybody feels the Fed is and will continue to make a mistake. So yes, this has been an uncommonly bad year for diversified investors. You tend to see years like this, once a decade, maybe once every 2. And hopefully, for the sake of all investors, this is something that we'll put behind us and we won't see for another few decades. But again, at this point in the game, for people looking to run from fixed income, to flee bonds, to sell everything they own, this is not the place to be doing that. This is the place that these things are actually starting to look enticing to us. Now, when we talk about the market, okay, we shared this chart, and you can go back and check the receipts, shared this chart in July. Okay, we shared it, we sent it out via email, we shared it in a video, and we talked about the inevitability of where this market was going, which was likely somewhere around 3,300 on the S&P 500. Now, at the time we shared it, we were about 3,670, almost 3,700. And when you look, and again, not looking to take credit for calling this move, but we just want to convey to you that while it is painful, while this market has been wearing on investors and just destroying investor psyche, there has always been a destination in mind. Okay, there has always been an end to this downward cycle, a point where we will load the boat and ride this wave back up for many years to come. And we talked about at that time that the market was going to be very choppy. We were going to see some relief bounces, but ultimately all paths were suggesting that this market was going to go to 3,300. Now, if we fast forward, we are basically now about here on this chart. So we had that rally through August, mid-August. We have sold off since, and we're likely going to get a little bit of a relief rally here, whether it's today, tomorrow, next week. You know, math and technicals would suggest that that is coming. And then we will get that final low. What we believe will be the cycle low, the ultimate low for this entire bear market. That will bring us somewhere around 3,300. Now, you might say, where do you come up with these numbers, right? You draw these beautiful squiggly lines on a chart. What does it all mean? Well, this is how we quantify and make assessments on where the market could potentially go in a cycle like this where the Fed continues to put pressure on the markets. We come up with 3,300 a couple different ways. First of all, we look at the pre-COVID highs, right? We look at the pre-COVID highs and we basically draw that line across because markets have a history of breaking out and then coming back to retest previous breakout points. Now, when we say a breakout point, it's basically the pre-COVID high. We went below. The breakout point was breaking above that all-time high. So when you draw a line straight across, what do you know? Where is the pre-COVID high? About 3,350 on the S&P. Take it a step further. When we look at potential retracement, right? We look at the rally of this market from the COVID low to the post-COVID high. And when we quantify these things, right, because markets are animalistic, folks, they tend to move in waves and they tend to retrace those waves. And this happens in both directions. So we look at the entirety of this move, and in technical analysis, after a big move like that, it is not uncommon to see the market retrace 50 to 60% of this rally, right? So just to kind of give this like in simplistic terms, here's your rally. If we retrace 100% of the rally, we gave it all back, right? So we'd be back at these levels. So your 50 to 60% retracement, 50% is about 3,500, 61% is about 3,230, right? So we draw a line in the middle there. Where are we at? About 3,300. And then the final metric that we look at is S&P earnings, right? Earnings per share. How much money are companies expected to earn? And if we look at previous recessionary cycles, previous bear market cycles, right, we tend to see the S&P bottom when earnings per share is averaging about $200 per share earnings for S&P 500 companies. At this point of the peak of last year, we were at about $240 per share of earnings for S&P 500 companies. And when we readjust for $200 per share earnings, that takes us down to 3,300. Now, is the market going to stop on a dime at 3,300? Not sure. Could bottom before that, could go a little bit lower than that. But the point is that market at that level, stocks are once again cheap. They are trading at a discount to their cash flows. And folks, this is not a game of guessing. This is not a game of gut instincts. We can rely on solely facts and data to guide us through these difficult times. And yes, facts and data, sometimes there's a delayed gratification, right? We can have all the facts and data that's aligning with our view and everything looks great, and yet maybe markets still continue lower for a couple weeks or a couple months. But inevitably, sanity will return, normalcy will return, and investors will do what they always do, which is look for value and opportunities. And those days, will come yet again. So again, very brutal decline, has been very, very difficult. But when we zoom in, basically we're at a situation now where the June lows look like they are not going to hold, right? The S&P is below the June lows. The Nasdaq still holding above the June lows. At this point, this is a necessary evil that we need to go through to get this over with. The whole market was watching the June lows. The market clearly pushed below that, causing a lot of selling pressure for anybody who said, you know what, this line in the sand, get me out of here. So now we're seeing that type of selling wash through the market. This is a necessary evil, folks. We need a little bit more pain. We need that capitulation, that fear spike. I never root for markets to go down, but when we're in these cycles, we need one really bad day where we get a deep red open and then a violent rally off the lows where the fear gauge spikes immensely. That will be the tell that that is the real deal and that is the bottom. But nonetheless, the market is working through this process. We have had a ton of volatility. Markets were up 3% across the board yesterday. The market's down 2.7%, 3% across the board today. So we're doing a lot of gyrating. Here's the last 5 days in the market. Beautiful rally yesterday. Give it all back in 15 minutes today. This is the nature of the market that we're in, folks, where there is just a lack of buyers, right? There's a lack of buyers. We're heavier in cash in our strategy than we have been at any point over the last 5 years, and we're not in a rush to buy anything either. But don't make the mistake of thinking lack of activity means there is a lack of a game plan or a strategy. We will be big time buyers of this market, but we have to do it when the time is right. There is no sense for us to try to catch a falling knife. And you have to remember, right, bottoms, everybody wants to guess where the bottom is. Everybody wants to hit it perfectly. And sure, we'd love to too, but that's a fool's errand. A bottom is a one-day price point, but the bull market that will come next will last for years. So we don't need to get this exactly right. We just need to continue to remain calm, to weather the storm, and be ready to buy with both hands when the sun starts to shine again, because many of these assets in this market have been destroyed. They've gone through the ringer. The sentiment is washed out. People have thrown in the towel. And in the next cycle, these are the companies that are going to fly. So again, we're being patient with what we own. We know stocks are down. We are not giving up on good companies that have nothing wrong with their businesses just because the Fed is leaning on this market like an elephant, right? So what we're going to continue to do is evaluate Fed policy as it comes. It is our belief and continues to be our belief that the Fed has 1 to 2 interest rate hikes left in them. And at that point, the deterioration that they have caused in global credit and financial markets will be so clear cut that they will have no choice but to pivot policy. The evidence is there, folks. Rates have tightened tremendously. Liquidity has dried up tremendously. The bond market is sending all sorts of signals to the Fed that they have done enough. And we know the Fed always tends to be late in their decision-making process, but they will eventually get to the right place. And if you remember 2018, right, markets were having a banner year, 2018, everything was great. Markets were up 25, 30%. And all of a sudden, the Fed made a policy error, and we gave up 9 months of gains. In 2.5 short months, the market finished negative for 2018, okay? From up 25% to down 5% inside of 6 weeks. And then the Fed got their act together. They realized the mistake that they had made. They pivoted, and the market went on and went gangbusters in 2019 and 20 and the first half of 21. So again, we expect the game plan and the way this is going to play out to be very similar. And when we take a look at seasonality, we're going to end with this today, right? Midterm election seasonality, we are right on par. Second year, new Democratic president is the red line. We see weakness to start the year, right? A rally into mid-August, right? Pretty accurate based on where we've been. Selling off into September, some sort of a rally early October, but looking for that bottom to coincide with late October, maybe early November, conveniently right before the midterms, folks. So again, keep it in mind, this has been painful, but the destination, where'd we go here? Hold on a second. This has been painful for people in markets. This has been very painful for everybody to watch. We get that. It's painful for us to watch you go through it. But there's always a plan. We have to stick with the plan. This was the plan we sent out on July 1st, And we are almost to the bottom of this cycle, folks. So this is not the place to throw in the towel. Keep calm, invest on. We're almost there. And when this turns, there will be a magnitude of opportunities for us to take advantage of. So if you have any questions, reach out to us. Always here to talk to you about the things that matter with your money. Have a great day, and we'll see you back for the next Heritage Market Update.